What are derivatives? Derivatives are among the most complex investment products on the market and are discussed controversially, especially in times of crisis. Unfortunately, many retail investors do not understand how derivatives work. We explain what a derivative is, what types of derivatives there are, and how they work. Good to know. Derivatives are financial products whose prices are derived from an underlying asset. Underlying values can, for example, be securities such as bonds or stocks. However, a derivative can also be derived from price or interest rate developments, commodity prices, key figures or indices. Derivatives are mainly used by private investors for speculation. Another purpose is to hedge against currency and exchange rate risks and to map raw material prices. The most important types of derivatives include reverse convertibles, swaps, futures, certificates, options or warrants, and CFDs, contract for difference. What is a derivative? The term derivative is the generic term for a large investment universe and is derived from the Latin word derivare, which means to convey. This term explains very well what a derivative is. A derivative is a financial product, the price of which is derived from a base product such as a security, a bond or a share. A derivative can also be derived from price or interest rate developments, commodity prices, key figures or indices. The price of a derivative thus has its origin in another financial product, benefiting from the future rise or fall of its base product. It is designed in such a way that its price follows that of the basic product disproportionately and can therefore be used to hedge against losses in value. What types of derivatives are there? The most important types of derivatives include reverse convertibles, swaps, futures, certificates, options or warrants, and contracts for difference, CFDs. They can be traded both on the stock exchange and over the counter, OTC, whereby a derivative that is traded OTC is free in its design. How does a derivative work? Trading a derivative is roughly speaking nothing more than a bet in that you can be right or wrong. The different types of derivatives have different levels of risk depending on the leverage effect of the product, so that a derivative can be used both for speculation and for risk hedging. Speculation. A derivative allows you to bet on price developments without having to buy the base product. If you want to benefit from a rising oil price, you can buy a derivative on the oil price. For example, if the current price of oil on the stock exchange is $100 per barrel, you can buy a derivative with a 1-to-1 mapping for $10. If the price of the base product rises by 10%, the value of your derivative rises to $11. If you now want to take greater advantage of the rising oil price, you have the option of buying a derivative that represents the price of the base product 1 to 10. In this case, your derivative would no longer rise to $11 but to $20, and you would have made a profit of $10, in this case 100%. Risk coverage. A derivative can not only be used for speculation, but also to hedge currency and price risks as well as commodity prices. In technical jargon, this type of risk protection is called a hedge. Hedge transactions can be set up, for example, via futures and options on the stock exchange or outside the exchange in over-the-counter markets. The desire in hedging is to fix the price of a certain commodity, security or interest rate for the future. Let's look at this using a simple example. A wheat farmer wants to hedge against the risk of a falling wheat price and for this purpose buys a future that assures him that the price of his wheat will be $200 per ton by the end of the year. His counterpart is a biscuit factory that wants to hedge against rising wheat prices and wants to pay a maximum of $200 for a ton of wheat at the end of the year. If the wheat price falls on the stock exchange, the wheat farmer has made good business because at the end of the year he can sell his wheat to the biscuit factory for $200 per ton. However, if the price of wheat on the stock exchange rises to, for example, $230, the biscuit factory has the advantage that it gets the wheat from the wheat farmer for $200 per ton. As you can see, hedge transactions are perfect for hedging raw material prices, but also for hedging exchange rates when business partners are based in countries with different currencies. In these cases, setting up a hedge can significantly reduce the risk for both parties. Conditional and unconditional futures. Depending on its fulfillment claim, a distinction can be made between a conditional and an unconditional derivative. In the above examples of the oil and wheat price, it is an unconditional derivative that must be executed in a binding manner. In this context, one speaks of an unconditional forward transaction, since the time of fulfillment is determined in advance. Unconditional forward transactions are usually realized through futures, swaps and forwards. In contrast, there is no obligation to perform the service in the case of conditional forward transactions. The owner of the derivative only has the option but not the obligation to perform the service. For example, if the farmer had bought an option on the wheat price, he would have the option of selling the wheat to the factory at $200 per ton if the market price is below $200. If the price is higher, he could simply let the option expire and sell it at the market price. In order to have this option, the farmer has to pay the biscuit factory, the issuer of the option, an option premium, regardless of whether the wheat farmer uses the option or lets it expire. Keep in mind, the fact that the global derivatives market has now swelled to more than $600 trillion clearly shows that there is far more risk hedging and betting than deals. This is an indication that there are numerous speculators on the world market and that there is therefore a risk that raw material prices in particular will be artificially driven up. In the past, banks were therefore discredited for having driven prices up so high through speculative transactions on commodities such as rice and wheat that ultimately poorer countries in the third world could no longer afford them. Conclusion. With the help of a derivative you can earn high profits very quickly through speculation or hedge your share portfolio. However, depending on the type of derivative, you also have a higher risk of loss. How you can do it, too. A derivative can be bought through an online broker or a bank. If you want a broker with a current account and desktop access, for example, Comdirect has recommended offers. If you are smartphone savvy, a reputable broker app is Trade Republic, that we already recommended several times in previous videos. Find links to both offers in the description box below.